Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Ngwiri and I practice within the financial services industry in Kenya. Today, ladies and gentlemen, we are discussing about portfolio management. The focus of today's class, ladies and gentlemen, is contemporary issues and emerging trends. We are going to narrow down our discussion towards investing in international markets. Now, what we're going to discuss under this wonderful topic of contemporary issues is just the general issues or the issues which are being discussed along in foreign markets and also in our local markets right here in Kenya. We are going to discuss about the considerations before investing in foreign markets, and then we're going to move ahead and discuss about the methods of investing in foreign equity securities, and thereafter we're going to look at the factors to consider before investing in foreign markets. So let's dive right in, ladies and gentlemen. We start by mentioning the following, ladies and gentlemen, that the considerations to be the considerations to be factored when investing in foreign markets, international markets include, so put it like that. Number one, we talk about political factors, or what we call geopolitics, political factors. What we're saying is how peaceful is the country in as far as politics is concerned. So this is a consideration that you need to factor in. So I just put a bullet over there and say geopolitics and its influence on foreign direct investment. Geopolitics and its influence in or on foreign direct investment. Number two, ladies and gentlemen, so just going to bring about some distinction there. Political factors, going to be very brief, not too detailed. Number two is economic factors, right there. So probably, maybe at that point you may not really get to understand what we're talking about when discussing about investing in international markets. Let me just bring you up to speed. Please forgive me for that. So we're saying that this is, say for example, Kenya. We want to invest in Uganda, right there. Possibly maybe in Tanzania. That. I'll use TZ to denote Tanzania, UG to denote Uganda, and K to denote Kenya. So what are the considerations before a Kenyan wants to invest in Uganda or a Kenyan wants to invest in Tanzania? The first factor, ladies and gentlemen, is political factors. How is the politics or the political temperatures right over here? Could be, say for example, in one of the countries over here, you could be able to have a regime that is kind of dictatorial. It may not really be able to allow for foreign direct investment to come into their countries like that easily. The second point right over here, we're talking about economic factors. So the economic factors of these countries, because we're saying that the Kenyans over here want to invest in Uganda, so the factors, the talking points over here should be the GDP, inflation, interest rates, and possibly exchange rates, amongst other factors there. So when talking about economic factors, we say the influence of GDP, interest rates, Interest rates. This is gross domestic product. The interest rates, exchange rates, change rates. We are talking about inflation. All these have an influence towards Kenyans investing in Uganda and investing in Tanzania. If, for example, the GDP is not, is probably maybe the growth rates in Uganda and Tanzania are not up to the speed that the Kenyans actually want, then they would be able to prevent them from investing in those countries. Because probably maybe you're holding a portfolio right over here. This is just an example, guys. And probably holding a portfolio over here that also wants to grow. You want to grow the value of the portfolio. And the only way to do it is to invest in those economies that also produce significant growth in GDP, inflation, rather GDP only, and maybe inflation rate. You don't want to have modest amount of inflation because you're saying the purchase of goods and services or purchasing power in Uganda and Tanzania, if you put it on a Kenyan scale, it might also be quite expensive for the Kenyans to actually put it to invest in Uganda there. The interest rates, the prevailing interest rates, take a 10-year bond yield, is it, or maybe the lending rates within Uganda and Tanzania might not really be favorable over there. The exchange rates, Kenya shillings to Uganda shillings, probably the Ugandan shilling is actually strengthening more than is actually strengthening more than the Kenya shilling. Then that actually would present an opportunity for the Kenyans to actually invest in Uganda shillings, because we're seeing the Ugandan shillings is actually strengthening against the Kenya shilling. So that's what we're saying. Currency risk or currency exchange rates needs to be factored in or needs to be considered when investing in international markets. I'm just using this as just an example over here. These same factors also affect when you want to invest even in European countries and also in the US there. So domestic factors, we're saying that the influence of GDP, interest rates, and exchange rates, inflation on the investment manager's portfolio, on the investment managers. We go up over here, portfolio. So those have an impact on the investment decisions as to whether you're going to invest in Uganda or Tanzania or wherever, Europe or even the US. Next point, we're talking about socio-cultural factors. Number 3, social-cultural factors. Socio-cultural factors, and we're saying these socio-cultural factors considered needs to be based on cultures and beliefs. So we're saying that the cultures, beliefs, and maybe traditions have of a given country have an impact on investments, on foreign direct investment. Foreign direct investments. This is how so. We can come back over here to a diagram over here, to a drawing. We're saying that if we are saying we have a predominant, just for example, if you're saying that in Kenya that we are predominantly maybe say for example Muslim or are believed to have the Muslim faithful or have a following towards the Muslim proposition, then we would only seek to invest in those countries that have got Sharia compliant laws or products. So those are what you're saying, the cultures and beliefs. And we're also talking about maybe say if Kenyans, for example, are also predominantly Christian, then it would mean that they would want to invest in countries probably that have got maybe the norms and the cultures that are almost similar to what the Kenyans actually believe in. Like that. So that also has an influence in foreign direct investment. foreign direct investment from that country, from Kenya, cannot be able to come into Uganda as expected, because probably maybe there's a barrier in terms of cultures and beliefs and norms, as well as traditions. So moving on, we can talk about, I'm just being very brief, number 4, and for consistency purposes, I was supposed to underline this using red. Forgive me for that. Here, socio-cultural factors. And number 4, we're talking about technological factors. Technological factors. And we're saying technology, the impact of technology, of course, following the adverse effects of COVID-19 pandemic, led to innovations of how individuals can actually make, conduct meetings, trainings, and even modes of payment. It can also be done through using over the internet there. So of course, individuals came up with payment platforms that can allow seamless seamless transfer of funds without any risk over there. And that means what? Precise point is this: commercial banks actually used to have probably maybe a given number of tellers, and even now what you're saying, automated teller machines. Now you're saying that individuals to some extent are not going to automated teller machines as the way they used to. They are now, because of the innovation that has been done by the CB, commercial bank, towards payment platforms online, as well as mobile banking, has actually transformed the commercial banking ways of doing business over here. Now, in terms of the tellers, you don't find as many tellers as the way they used to be, because you can be able to conduct your transactions online or via your mobile phone. So we're saying advancements in technology, has allowed individual and institutional investors to invest in foreign equity securities or foreign securities, removing bottlenecks, removing bottlenecks that were previously in place. Because we're saying that nowadays you can even trade using just a mobile banking, just using your phone. You can even trade on cryptocurrencies, you can even cryptos, and you can also trade on currencies, you can do also on commodities, just by the confines of the convenience of your phone. So you don't really have to physically go to an exchange or even do it on online or using a computer machine and so on and so forth. That's the way it is. That's what we're talking about, ladies and gentlemen. So technological factors also have brought about ease and the way individuals actually transact. So in a country that is technologically savvy, then there's going to be a challenge in terms of how you can be able to execute investment decisions there. So if countries are not moving with a fast pace at which technology is actually growing, so you'd expect then there is going to be a hindrance in terms of receiving foreign direct investment there. 5 there. So we talk about socio-cultural, technological, and then there is ecological factors. Our commercial banks are financial services firms, financing initiatives are financial services firms financing initiatives that drive or that cater for climate change, cater for climate change, that is a question mark over there. Commercial banks right over here, what are they financing? Who are they providing loans to? Are they providing loans to individuals and institutions and for a noble cause that are geared towards climate change or that are geared towards conserving the environment? My apologies. That's the question that should be asked. So if commercial banks over here, CBs, are financing, say, activities that pollute the air, maybe even geared towards, maybe to some extent, civil rights, or maybe civil rights, ecological is geared towards the environment, sorry. So it's civil rights is probably maybe legal environment. So pollute the air and maybe conserve, or maybe are geared towards maybe bodily harm, causing bodily harm, like that. Say, for example, I'm just using this as an example, BAT, British American Tobacco Cigarettes, producing company. So what are commercial banks' activities geared towards? Are they geared towards polluting the environment or providing finance to firms that pollute the environment? Or are they providing loans to institutions that are going to produce products that cause bodily harm, including cigarettes, alcohol, and so on and so forth like that? That's what we should be able to consider under the ecological factors. And that really affects. So if BAT is trying to seek financing or investors want to invest in BAT, and then there's going to be a deterrence, there's going to be some foreign direct investment may not really come because they're saying that the element of ecological factors are going to prevent them from receiving finance from commercial banks or from maybe say investors in foreign countries their own. So that is ecological factors. And we move on to this other side. We discuss other factors. Here, after ecological environment, we move ahead and discuss about legal environment, legal factors. And we're saying under legal factors, we talk about the impact of regulatory change on securities holding. So if initially the allocation or the preferred allocation from the regulators was saying it was going to be 0.25, 0.25, 0.25, 0.25, like that, all a quarter like that, we are saying that it changes and says that this is equities, fixed income, derivatives, and alternatives. It changes and says that the preferred portfolio should have something to do with something over here, 0.35, and here it's 0.15, for example, like that. This is 2.5. So it means that the portfolio holding or foreign direct investors would have an appetite. If initially they had an appetite for this, they'll not be able to provide financing to this part over here as much as the way they did because of that regulatory change. We're also seeing activities that are geared towards civil rights, like that, and so on and so forth, might also be contributory towards foreign direct investment. Individual investors or institutional investors may not be willing to invest in countries that do not follow or are not observant of civil rights or civil activism, civil activists, and so on and so forth like that. So that is part of the legal factors there. So it would deter foreign direct investments. Countries would not be able to invest in those countries which do not follow or do not have civil rights. So other factors include, other factors over here include, and we're talking about something to do with country risk. So talking about country risk. This is the risk that is posed by a country, especially in trying to determine maybe in terms of its credit rating, its ability to borrow from international markets, say maybe from the World Bank, the IMF, and so forth. So this country risk is also a factor that deters foreign direct investment or investing in international markets. Then we're also talking about maybe transaction costs. Transaction costs in the foreign country where you would wish to place an investment. If the transaction costs are actually high, then that would deter participation in foreign direct or in foreign or international markets. The next point over here is currency volatility. Currency volatility. Of course, ladies and gentlemen, I had discussed right over here about the exchange rates. So probably maybe I may not it would not be necessary for me to explain this point again, because I already talked about it in the currency exchange rate, and I said the currency, how erratic is the currency exchange rate. Maybe say, for example, the KES versus the Uganda shilling, like that. Is it very volatile? At one time, is the Kenya shilling losing ground against the the Uganda shilling, or is the Uganda shilling losing ground against the Kenya shilling? How erratic that moves would affect foreign direct investment or participation in international markets. We're also seeing the final point is, liquidity. When in participating in international markets, liquidity is a key concern, and maybe you're investing in markets that do not provide liquidity or are not as liquid as maybe say foreign markets. Maybe emerging markets may not provide that element of liquidity as much as foreign markets would do. So that would deter investors in participating in international markets, there. So having discussed the considerations when investing in international markets, we can then move on and discuss about the methods that are used in investing in foreign equity securities. So methods of investing in foreign equity securities. We can do that right on this other side here. Methods of investing in foreign equity securities. Methods of investing in foreign equity securities. Methods of investing in foreign equity securities. So how do we invest in foreign equity securities? The first method is we can mention American depository receipts. Number one, American depository receipts. What is also called as ADRs. Under ADRs, we say that are a convenient way, are a convenient way to buy foreign stocks or foreign securities. To buy foreign securities. Convenient way to buy foreign securities. Foreign companies use American depository receipts or ADRs. Use ADRs to establish a presence. In the US markets. In the US markets. And sometimes sometimes have some capital, sometimes require capital. These are what we can say a convenient way to buy foreign securities. They're saying foreign companies use ADRs to establish presence in the US markets and sometimes require capital and sometimes require capital. I'll move on this other side right here. So we say that each ADR that a foreign company issues, represents underlying share, an underlying share, I'm not written it properly. Underlying share or number of underlying shares. They are listed, traded. They are listed, traded, and settled just like shares of the US companies. Settled just like shares or securities. It's like securities. Securities of US companies. What are we saying? Each ADR that a foreign company issues represents an underlying share or number of underlying shares. So an institution over here issues depository receipts based on the number of shares right there. They are listed, traded, and settled just like securities of US companies on the NYSE or the NASDAQ. Let's move on to the second one. Global depository receipts. Global depository receipts. So for consistency, and a line in red. We're saying that a depository receipts or depository receipt are depository receipt, or we say, let's just describe what it is. A bank, pardon me for that, a bank issues shares of a foreign company in international markets, typically in Europe, and makes them available, to to investors within and overseas, to investors within and outside a country, outside a country, outside a country. Let's stop there first and we proceed. A bank, maybe a depository bank, issues shares of a foreign company in international markets, typically in Europe, and makes them available to investors within and outside a country. So this is the country here. This bank or a firm over here issues, makes a deposit in terms of the shares with this bank over here. This bank then issues depository receipts in foreign markets, like that. So once it issues foreign depository receipts in foreign markets, investors in Kenya, in Uganda, can actually invest in those securities in those other countries once they've been issued that. So that's a simple way of how to invest in foreign securities. So we're saying that a bank issues shares of a foreign company in international markets, typically in Europe, and makes them available to investors within and outside a country. So that is it for global depository receipts, but we may proceed as a conclusion, as a parting shot, and we can say that many global deposit GDRs, many GDRs are denominated in USD, US dollar, but some may also be issued. Some may also be issued in euros, and are traded on the LSE, London Securities Exchange, or Luxembourg exchange. So many GDRs are denominated in USD, but some may also be issued in euros and are traded on the LSE, Luxembourg exchanges, amongst other exchanges there. Once we've discussed the second one, which you're saying is global depository receipts, we move over on this other side and discuss others. Foreign direct investment. Number 3, foreign direct investment. Foreign direct investment. And we're saying under the foreign direct investment right here that one is expected to open a global account, with a broker, in your home country, e.g. Fidelity, or to open an account with a local broker in the target country. In the target country. That is it for foreign direct investment. You decide that this is Kenya, you want to invest in Uganda, you go and open, say, for example, a CDS account, Central Depository and Settlement account in Uganda. Then, once you open a CDS account in Uganda, you can be able to invest or purchase securities as the way you'd actually wish. Of course, when currency flows from Kenya to Uganda like that, you expect to have that what we call exchange rate or conversion exchange rate between Kenya and the Kenya shillings and Uganda shillings there. So you need to convert the Kenya shillings into Uganda shillings for you to be able to participate and invest in securities in Uganda. That's what you're saying, direct investing. And so we're saying that one is expected to open a global account with a broker in your home country, e.g. Fidelity, or to open an account with a local broker in the target country right there. So there are two ways there. So first of all, open a global account with a broker in your home country. So in your home country, which has got if your country has got, say this is Kenya, has got a global broker over here, then that's one of the ways you can be able to participate in foreign markets, and you'll be able to trade using that broker over there. And the second case is the one that I just given you over here. You decide to open a CDS account right over here, and then of course you convert the Kenya shillings into Uganda shillings so that you can be able to participate in foreign markets there or invest in Uganda. We're saying number 4, guys, global mutual funds. Mutual funds. Global mutual funds is also another way. Pardon me, I keep underlining with black. Global mutual funds, we're saying here, one can opt for a mutual fund. One can opt for a mutual fund that focuses on international equities or fixed income. I said opt for a mutual fund that focuses on international equities, focuses on international equities or fixed income, That's it for global mutual funds. One can opt for a mutual fund that focuses on international equities or fixed income. That's it, by investing in a pool of products. So this mutual fund accepts funds all over the world. And then it is, of course, professionally managed by a portfolio manager right over here. And so now this is Kenya. You are the one who's actually invested in that mutual fund that could actually be focused, maybe say, or divided into two, maybe fixed income and maybe equities like that. So this is Kenya. Investors actually invest in fixed income part. They also have an option to invest in the equities international markets. Mutual funds that are available to international investors. Number 5, we're talking about multinational companies. Number 5, multinational companies. And here we can be able to say that occurs when domestic companies, it occurs when domestic companies, when it occurs, saying that it occurs when domestic companies that desire significant sales, that drive significant sales, that drive significant sales right over here from abroad. So let me Now highlight the salient points. So when domestic companies, or it occurs when domestic companies that drive significant sales from abroad are purchased, full stop there. For example, we are saying if we have Coca-Cola company in the US market over there, Coca-Cola, significant sales of Coca-Cola actually come, ladies and gentlemen, from foreign or from maybe the customers who are actually abroad from the US there. So Coca-Cola, e.g. Coca-Cola, e.g. Coca-Cola. So significant sales of the company, yes, it's an American company, but significant sales or significant revenues of Coca-Cola actually come from outside the country there. That's how you can be able to participate in investing in international markets, how you can be able to invest in international markets over there. You could also invest in international markets based on using, foreign, forex trading. 6, forex trading, where you buy and sell currency pairs of companies which are, or not companies, buy and sell currency pairs of countries or exchange currencies. Say, for example, Euro USD stroke CHF or Euro USD. So investing in the Euro USD currency pair using forex trading, you are also in a way investing in international markets there. So this is also another way of how you can be able to invest in international markets, amongst other ways. But these are the most common ways of how you can be able to invest in international markets. Now, to conclude, we will discuss about the factors to consider, when selecting an investment stroke asset class. The first one is security. Let's talk about when investing in asset classes, they need to provide some element of security such that it cannot actually be stolen by someone or cannot be purchased by someone unless you actually authorize for that. Number 2, liquidity. Securities must at least provide some element of liquidity at short notice. So when you want to sell off your asset class, or maybe say if it's real estate, then you can be able to do so with relative ease. That is liquidity. Number 3, asset classes should be able to generate some element of return. So an asset class or an investment should be able to generate some return. There are times when they may not be able to generate positive returns, but at least after some time, an investment or an asset class should be able to generate for you some return. There, number 3, growth. They should be able to maintain their purchasing power. So growth is also a significant element of it. And of course, growth is tied with inflation. It's tied with the inflation. So securities should be able to actually grow in terms of capital gains there. So these, having discussed about these factors to consider when selecting an investment, we can be able to end this session, ladies and gentlemen, so that I can be able to give you an assignment for you to be able to just review. So the assignment that I have for you today here, about explain the methods of investing in foreign equity securities. Explain the methods of investing in foreign equity securities. That is what I want you to go and break down and understand, so that you can be able to and comprehend this part of investing in international markets. Thank you for being with Manifested Publishers. God bless you.
Hello there, I'm Patrick Kamau Kamure, and I'm the one who is taking you through the advanced taxation, where I continue teaching you about the taxation of the businesses. And so far, we have been able to look at the partnership, which we said it consists of two areas: the admission and retirement of a partner during the year, and also the conversion of a partnership into a limited company. Once we are done with that, then we go to the taxation of the limited company. Now, we have been able to look at the questions about the admission and retirement of a partner during the year, and also the conversion. But in the conversion, we were able to only look at one side of determining the taxable income. That is when you are required to use the net profit method. So how about in case where you are required to use the gross profit method? How do you go about it? So I want us to look at a question concerning that. This question comes from November 2015, question number 3. And I want us to go through it. This is what the question says. James and Katana established a partnership business, sharing profits and losses in the ratio of 3:2 respectively. The following is the income statement of the partnership for the year ending that 1st December 2014. We have the sales consisting of unrealized foreign exchange gain, capital gain on sale of shares, recovery from insurance on stock stolen, goods transferred to a branch at cost, dividend from Kali Cooperative Society, and total incomes. Then rest expenses, which you have purchases, purchase of computers, partner salary, legal fee, repair and maintenance, rent and rates, interest on loan, general expenses, motor vehicle expenses, insurance, preliminary expenses, director's fee, audit fees, debenture interest, traveling expenses, and net loss. Additional information number 1, the partnership was converted into a limited liability company by the name Kaka Limited on 1st October 2014. Incomes and expenses accrued evenly throughout the year unless otherwise stated. Number 2, purchases and sales were inclusive of VAT at the rate of 16%. Closing stock was valued at 1840,000, while opening stock was at 10,000 of the sales, net of value added tax. Number 4, legal fee comprised petition to Association of Manufacturers, notice for change of business name, conveyance fee for business premise, stamp duty, negotiating a business loan, recovery of bad debts, signing a 100-year lease agreement, purchase of partners' private residence by James, appeal against tax arrears. Number 5, repair and maintenance comprised purchase of furniture, installation of neon sign, designing of an office block, cost of partitioning office block, repainting of the business premises. Number 6, general expenses included registering of patent rights 64,000, flotation costs of 48,000, and negotiating costs for an additional piece of land for business expansion at 56,000. Number 7, interest on loan include interest on partners' capital of shillings 100,000, which was shared according to the profit and loss sharing ratio. Required 1, a statement of adjusted taxable profit or loss for the business for the year ending that 1st December 2014. Hint, start with gross profit. B, comment on the tax position of James, Katana, and the company. C, citing examples, advise James Katana on 2 areas of tax avoidance that they could explore for the business. So, we can see in this question, we are required, number 1, to get the statement of adjusted taxable profit loss of the business. Now, in this case, you take note that there is a conversion. A partnership business that was existing was converted into a limited company as per additional information number 1. And from the additional information number 1, we can see the partnership business lasted for a period of 9 months, and then the limited company 3 months, because the conversion happened on 1st October 2014, and the year of income is ending on 31st of December 2014. So how do we go about getting the taxable income? Remember, we say that conversion, we always use the gross profit method unless it is stated otherwise. Now here it is hinted that we start with the gross profit. although they have hinted, they don't have to hint. Even if they haven't hinted, we are supposed to use the gross profit method. When they say you start with gross profit, they mean that gross profit become one of your first income, and that does not mean that you look for gross profit somewhere and then you transfer here. No. What you do, you have to post the sales, the cost of sales, you get the gross profit, and then you continue from there. Another thing that we said about the conversion is we must be able to separate the two business, the period of the partnership and the period of the limited company, because these are two different businesses. So when we are taxing them, we tax them separately and differently. So here we start. So as we have noted, the partnership lasted for a period of 9 months in that year, and the limited company 3 months in that year. So here we are using the gross profit method. So we start with the sales. We'll start with the sales. So we take 9 over 12, 3 over 12 of the sales figure given is 67,28,000. But there's something that we are told about this sales. If you look at additional information number 2, we are told that the purchases and sales were inclusive of VAT at the rate of 16% where applicable. So that means this sales has VAT. So this sales is at 116%. Remember, when you're getting the taxable income, VAT should not be factored in anywhere. So if they have the VAT, we need to remove the VAT. So we want to get the sales without VAT. So if this is 116%, we must be willing to get the 100. So take note that we are not interested in the VAT, the 16%. No, we want the cost without VAT, the 100. So if this is 116, 100 will be what? Cross multiply. It will mean that you multiply by 100 over 116. So 67,28,000 times 100 divided by 116, and then this we get is 5,800,000, and then we take times 9 over 12. That gives us 4350, and this other one is going to be 5,800,000 times 3 over 12, which we get 1450. Now, gross profit method, after getting the sales, we normally less the cost of sales. For the cost of sales, we normally start with the opening stock, of which case in this question, the opening stock we are told in additional information number 3. Closing stock was valued at 1840, while opening stock was 10% of sales net of VAT. So the opening stock is 10% of the sales net of VAT. The sales that is net of VAT does not have the VAT is 5,800,000. So you take times 5,800. That translates to 580,000. And then we add the purchases. The purchases is in the income statement. The first expense actually 2842. So plus 2842,000. But we are told this one as well, in additional information number 2, it had the VAT. So we must exclude the VAT. We do the same we did with the sales. So times 100 over 116. Let us get how much that is. So 2842,000 times 100 divided by 116 give us 2450,000, and then we less the closing stock. The closing stock is given in point 3, additional information number 3. Closing stock was valued at 1840. So minus 1840,000. And then also remember, we say that we also deduct any item that reduced the stock during the year. Do we have it? Yes. If you go to the incomes, among the incomes in the income statement, there is sales, unrealized foreign exchange gain, capital gain, recovery from insurance on stock stolen. It is telling you that there were stock that were stolen. So if they were stolen, this must be deducted from here. The stolen stock was 480 minus 480. You also have the goods transferred to the branch at cost. That, remember, you are just transferring goods from one place of the business to another, from the head office to the branch. There is no impact in addition to that because the stocks are still within the company. The branch and the head office are one and the same thing. And there is no other item that affected the cost of goods. So we cross. And then we apportion. Don't forget to apportion. We want the 9 months, so 9 over 12. The other one, 3 over 12. So we are going to have the 580,000 plus 2450,000 and then minus 1840,000 and then we minus 480,000. That gives us 710. And then we multiply by 9, divide by 12. 532,500. And then the other one is going to be 710 times 3 over 12. That gives us 177,500. So after that, we can now get the gross profit. Gross profit will be sales minus the cost of sales, in which case we have 43,50,000 minus 532,500, which give us 3817. 500. This other one is 1450,000 minus 177,500 give us 1272, 500. Now that is the gross profit, and then we said once you get the gross profit, you normally add other taxable so we need to go through the question, determine if they are taxable operating from operation. Now the incomes are in the income statement after the sales, where we have unrealized foreign exchange gain. Unrealized foreign exchange gain, we said we don't usually tax. We only tax realized, or if it is silent, just realized foreign exchange gain. The other one is capital gain on sale of shares. Shares are investment, so not operating. Recovery from insurance on stock stolen. We said that income from compensation from the insurance company for stock stolen, that is supposed to be a taxable income. So we come here, insurance compensation. We have 9 over 12, 3 over 12 of 480. So we have 9 divided by 12 times 480,000. That gives us 360. The other one is 3 over 12 of the same, 120. We continue. After the recovery from insurance on stock stolen in the income statement, there is goods transfer to a branch. That is not a sale. You're just moving your goods from one place of the business to another, from the head office to the branch. Nothing. Dividend from carry cooperative. That's an investment income. Here we want only the operating. After that, we have the expenses. Maybe in the additional information, you need to confirm with the additional information to confirm whether you have an income. But if you look at all of them from number 1, 2, 3, 4, 5, 6, 7, there is no income whatsoever. So meaning we can now less. So we need to go through the whole question again, and especially in the income statement where expenses start. Any allowable expense we deduct here. And the first expense is purchases. Now purchases we use to get the cost of sales. So it's already considered there. The other one is purchase of computer. Computer is not an allowable expense. It's a fixed asset. What we allow for computer is the wear and tear. And because here we are looking at allowable expense now, wear and tear should be deducted. So wear and tear on computers, we take 9 over 12, 3 over 12 of 25% of 130, 180. So 25% of 180, that gives us 45 times 9 divided by 12, give us 33, 750. The other one is 3 divided by 12 times 45,000. That gives us 11,250. There. So we continue. So the next expense in line is the partner's salaries. But we said partner salary is not allowable. It's for the partnership and it's not allowed. The other one is legal fee. Legal fee we said is usually allowable unless it has additional information. It is explained further, which is the case in here. If you look at the point number 4, it is saying legal fee complies, petition to association of manufacturer and the rest. So what you need to do, you need to post one figure here because we are using the gross profit method now. You post another allowable expense is the legal fee. So you take 9 over 12, 3 over 12 of the legal expense is 680 minus, because you want to remain with the expense that is allowable of the legal, just minus the non-allowables, the one that are not supposed to be allowable. In additional information number 4, we are told legal fee complies of petition to association of manufacturers. We had said anything paid to the trade association is allowable. Association of manufacturers, that is supposed to be an allowable expense. Then notice for change of business name. Now we said that for an expense to be allowable, it must be income generating. This one, change of business name, has nothing to do with the income generation. We don't allow that. So minus 64,800. Then we have the conveyance fee for business premises. We say the conveyance fee is the legal cost to transfer a fixed asset, and we don't usually allow it. So we minus 72,400. Again, stamp duty. Stamp duty is a form of tax. Taxes are usually not allowable. We said that. So we minus 36,600. The other one is negotiating a business loan. We had said legal cost relating to loan, bonds and debentures are not allowed. So this one is not. So 2,800. The other one is recovery of bad debts. Recovery of bad debt, we said, is usually allowable. We said any legal cost relating to debtors and customer allowed. Then signing a 100-year lease agreement. We say that the lease up to 99 years is the one that we allow legal cost. Any above that we don't. So this is not allowable. 128,400. After that, we have the purchase of the partner's private residence. We had said that any expense relating to the partners we don't allow. This for private, for the partners, we don't allow 150. The other one is appeal against tax arrears. We had said any expense relating to tax we don't allow. So this one is not. So minus 82. Then we cross. So whatever remains there become the allowable legal costs, which we apportion. So it is going to be 680,000. The overall legal cost minus the non-allowable 64,800 minus 72,400 minus 36,600 minus 20,800 minus 128,400. And then we minus 150,000, and then we minus 82,000. That gives us 125,000. Then we take times 9 divided by 12. And 3,750. The other one we say 3 divided by 12 of 125,000. That gives us 31,250. Then we continue. We go back to the income statement and continue looking for allowable expenses. After that, there is repair and maintenance. Repair and maintenance is allowable expense. However, there is a point number 5 about it. If there is something mentioning that item, go check so that you determine if there are some parts which are not allowed, you remove them. Like it includes purchase of furniture. That's a fixed asset. Fixed asset we claim wear and tear. Capital allowance for furniture. Installation of neon sign. That's supposed to be wear and tear. Designing of an office block. That's a fixed asset. That require IBD, office block. Cost of partitioning office block, wear and tear, 10%. Repainting of the business premise. That is now the allowable. So we have repair. So we take 9 over 12. 3 over 12 of the overall 568,400. Remove the non-allowables like furniture 96,000. The other one is neon sign 60. You have the office block 140. You have the partitioning 250. That. So we have 568, 400 minus 96,000 minus 60,000 minus 140,000, and then we minus 250,000. So that gives us 22,400, and you can take note that the only expense that is allowable in number 5 is repair of business premise. So if you remove all the others which are not allowable, you still remain with that, the 22,400. So you can as well pick that and call it repair and maintenance, and then you post it there. So we times by 9, divide by 12, which you have 16,800. And then we take the other one, which we saw is 22,400. Times 3 divided by 12, 5,600. Yeah. And then we go back to the income statement. We continue looking for allowable expense. After repair and maintenance, there is rent and rates. Rent and rates. And this one does not have additional information. So it's all about apportioning. 9 over 12, 3 over 12 of 244,600. So 9 divided by 12 times 244,600, which we have 183,450. The other one would be 3 over 12. 61,150. And then we continue after rent and rates. Interest on loan. Interest on money borrowed, we said is allowable expense. So interest on loan, which we take again 9 over 12, 3 over 12, of the interest on loan overall is 166,200. We minus, if you look at additional information number 7, we are told interest on loan include interest on partners' capital of 100,000, which was shared according to the profit sharing ratio. So in here, there is interest on capital to the partners, which is not allowable. We said so. So we remain with the remaining 166 minus 200 minus 100,000. That will be 66,200. Then we apportion 9 divided by 12 times 66,200. Give us 49,650. The other one is the same. 3 over 12 of the same. 16,550. There. Then we continue. We go back to the income statement. After the interest on loan, we have general expenses. General expenses are allowable expenses. Nine over 12, 3 over 12 of the overall general expense is 964,000. But we must minus, there is an additional information number 6 about the general expense, which we are told that it included registering of a patent right of 64,000. Patent right cost we said is not allowable, so that need to be minused, 64,000. Also, flotation cost of 48,000. We said flotation cost is for the shares, and it is usually for the company. So this one we have to remove it from here, although we said it's allowable on the company, but the figure that we want to remain with is the one we apportion, the one relating to the company and the partnership. This one needs to be taken to the partnership to the company directory. So we need to first of all remove it from here, 48,000. Also, there was an additional piece of cost of negotiating an additional piece of land for expansion, 56,000. That is also not allowable, a fixed asset. Then the remaining one is the one that is going to be allowable. So we are going to take 964,000, and then we minus 64,000, and then we minus 48,000, and then we minus 56,000. You have 796,000. Then we take the figure times 9 over 12. 796,000 times 3 over 12. 199,000. Deduct from there. Then we continue. After that, there is the motor vehicle expenses. Motor vehicle expenses are allowable. Remember, we say that is not the motor vehicle costs. That's not a fixed. It's the cost of running the motor vehicle, like repair, fuel, and all that. So that is allowable expense. So motor vehicle expenses, which we have 9 over 12, 3 over 12. This one does not have additional information about it, so it's all about using it the way it is, 840. So we will have 9 over 12 times 840. That gives us 630. We also take the 3 over 12. That gives us 210. After that, we go back. Insurance. Insurance, we said, is also allowable expense. It's a business expense. So insurance expense, which we have again 9 over 12, 3 over 12. There is no additional information on insurance. which we have 156,000. So we take 9 over 12 times 156. That gives us 117,000. And also the 3 over 12 of the same, 39,000. After that, we have preliminary expenses. We said preliminary expenses are expenses incurred before you start the business. All these expenses are not supposed to be allowable before you start. Preliminary, before. We don't allow them, we said. The other one is director's fee. Director's fee is allowable, but it only relates to the limited company. That's what we said. Only company has directors. So director's fee, which we have 600,000. So the whole of it come here. The other one is audit fee. Audit fee is a allowable expense and it cut across the board. It is for the partnership and the company. So audit fee, we have 9 over 12, 3 over 12 of 148,200. So we have 9 over 12 of 148,200. That gives us 111,150. The other one is for the 3 months, 37,050. After that, we have the debenture interest. We say debenture interest is allowable and only a company can issue debentures. So for the company, allowable for the company, debenture interest. We have the 60,000. The next one is traveling expenses. So traveling expenses is usually an allowable expense. So we'll have it here. And it is cut across the board. So 9 over 12 and 3 over 12 of the traveling 96,000. So we'll have 3 over 12 times 96,000. That gives us 24,000 here. Now this is supposed to be for this. 24,000 is for the company. And for the partnership, it is going to be 9 over 12, 72,000. When we get to the end of that, it's kind of we are done with the expenses, but we need to go through the additional information for an expense that is not in the P&L and it's allowable, the one not in the P&L. So we go to the additional information. Number 1, the partnership was converted into a limited liability company by the name Kaka Limited on 1st October 2014. Incomes and expenses accrued evenly throughout the year unless otherwise stated. There is no expense there. So we go to number 2. Purchases and sales were inclusive of VAT at the rate of 16%. There is no expense there. The number 3, closing stock was valued at 1840, while opening stock was at 10% of sales net of VAT. There is no expense. Number 4, legal expense. Now, legal expense is already in the P&L, and we consider the part that is allowable by removing the non-allowable parts. And in the same place, we have not seen any fixed asset that we can claim capital allowance among all those ones. There is none that is a fixed asset. So we go to number 5, repair and maintenance complies. So we had seen that the repair and maintenance is allowable. However, we remove the ones that are not allowable. However, we noted that most of those items, actually all the items in repair, were fixed assets. So we don't allow fixed assets, that's why we remove them. But now we claim the wear and tear. So we claim wear and tear for furniture and fitting, which is supposed to be 9 over 12, 3 over 12 of 10% of the furniture cost 96,000. So we take 10% of 96,000. That gives us 9,600. Then we multiply by 9, divide by 12, 72. And then we do the same. 3 divided by 12 times 9,600 give us 2,400. So another fixed asset in point number 5 is installation of neon sign. That require wear and tear as well. So wear and tear allowance on neon sign, which we are supposed to have again 9 over 12, 3 over 12 of 10% of 60,000. So that we take 10% of 60. That is 6,000 times 9 over 12. That gives us 45. The other one is the same. 3 over 12 times 6,000, 1,500. Yeah. And we continue. Another fixed asset that we have in point 5 is the designing of an office block. For the office block, we don't claim wear and tear, we claim industrial building deduction, IBD. So we have IBD, office block. So we have 9 over 12, 3 over 12 of the IBD we said is at the rate of 10%. So 10% of 140,000. So 10% of 140 give us 14,000. Then times 9 divided by 12. That gives us 10,500. The other one would be 3 over 12 of the 14,000. Give us 3,500. We continue. Another item we have is the cost of partitioning office block. Partition, we said, is supposed to be wear and tear. So here we don't look at the office, we look at the partition. Wear and tear, 10%. So wear and tear on partition of office block. So 9 over 12, 3 over 12, 10% of 250. So we take 10% of 250. That will be 25,000 times 9 divided by 12, give you 18,750. The other one will be 25,000 times 3 divided by 12, 6,250. There. And there is no other fixed asset in point 5. So we go to point number 6, general expense. For the general expense we had seen is in the P&L. We even deducted it here. And we were told it comprises of the patent rights. Registering of patent rights is not allowable, we had deducted. Flotation cost. Now, flotation cost, we said, is usually for the shares of the limited company. That one is specifically for the limited company and is allowable on the company. So we deducted from here because it's specifically for the company. Now we deduct it on the side of the company. So flotation costs of shares, which we have the flotation cost of shares to be 48,000 and only on the side of the company. Land a piece of land for business expansion? No, that is not allowable completely. Point number 7, interest on loan included interest on partner's capital. Interest on partner's capital is not allowable, and we deducted it when we were getting the interest expense. And that is the end of it. For now, we can get now the net taxable operating incomes. So what we do, we start from here, the gross profit plus other income minus now the allowable expenses. We start with the first one, 3817, 500, and then we add 360,000, and then we minus 33,750, and then we minus 93,750, then we minus 16,800, and then we minus 183,450, we minus 49,650, and then we minus 597,000, and then we minus 630,000, and then we minus 117,000, and then we minus 111, 150. So, and then we minus 72,000, and then we minus 7,200, and then we minus 4,500, and then we minus 10,500, and then we minus 18,750, give us 32,000. That's 2,032,232,000. Then we go to the company, 1272, 500, and then we add 120,000, and then we minus 11,250, and then we minus 31,250, then we minus 5,600, we minus 61,150, and then we minus 16,550, and then we minus 199,000, and then we minus 210,000, and then we minus 39,000, we minus 600,000, and then we minus 37,050, and then we minus 360,000, we minus 24,000, and then we minus 2,400, and then we minus 1,500, we minus 3,500, and then we minus 6,250, we minus 48,000. That gives us a loss of 264,000. Now, this is what we said for the partnership. Once you get the net taxable operating income here, it normally ends here, unless you are told to distribute to the partner and maybe determine the tax for each partner, but you don't go beyond there. But for a company, it does not usually end here. We normally add taxable investment income. We normally add taxable investment income if if the operating income is positive. That's the time we add the taxable investment income so that we can tax them together. But how about in case the operating income is negative? We don't add, take that loss and deduct it against income from other sources. That's what we said. So for this one, we will normally cross here. It will wait until next year where it can be deducted against the taxable profit of next year. But for now, it ends there. So we should not say we add then here because we have a loss from operation. We just now determine the taxable investment income separately and tax the company on that investment income only. For this question, we only had one investment income. In our income statement, the last income is dividend from Kali Cooperative Society, where we said if a company or a person gets dividend from a cooperative society, the withholding tax is not final. We said it's a non-qualifying dividend, that we should tax it further. So we come and now post it here. We have dividend from Kali Society, Cooperative Society, where we want only for the company, so we only want 3/12 or 51. And take note, the 51,000 is not net, because if it was net, we could have grossed it up to get the gross, yeah? Because net means that they had already deducted 15%, and we said that we don't tax the net. But this one is not, it's silent, so it's always assumed to be gross. So we take 3/12 or 51,000. Give us 12,750. And since there is no other investment income, then that becomes the only taxable income for the company. So, if you look at the required number 1, it means we have answered the question. Statement of adjusted taxable profit or loss for the business for the year ending 31st December 2014. Done. Hint, start with gross profit. That's what we did. B, comment on the tax position of James, Katana, and the company. Now, this is where you are told. If you are told to comment about the tax position of James and Katana, that is in the partnership. We said, once you get the taxable income of the partnership, you distribute and now tax it on the partners themselves. Since they have asked us about the tax position, we have now to distribute and even determine the tax they are supposed to pay individually. So what do? Distribute first. So we have to prepare the income distribution schedule. So we have the James. Maybe we need an extra one here, so that we have the James, Katana, and the totals. We said we want to distribute the operating income, so we start by distributing the taxable operating income of 32,000. That is what we want to distribute. Positive, remember? So how do you distribute? We said in the income distribution schedule, we normally look for 5 items. The salary, the commission to the partner, interest on capital, drawings, and we rest the interest on drawings. So we need to start from the top all the way down. We look for any one of those 5 items. Among the incomes, you'd expect to get like interest on drawings. That is the one that we are supposed to raise. But in this case, we don't have that in there among the incomes. You go to the expenses, purchases, purchase of computer, partner salary. Yes, we have the partner salary. But then, how are they sharing the salary? Now, there is nowhere, if you go to the additional information, there is nowhere we are told about how they were sharing the salary. This is what we said. If you're not told how they are sharing the 5 items, and actually you just look at the 3 actually, the salary, the commission, and interest on capital. If you're not told how they are sharing, share equally. Not according to the profit sharing ratio, share equally. That's the rule. So in this case, since we are not told about the partner salary, we share equally. So we'll come here and say partner salary. So the amount is 720, and then we share equally half of 720. That is going to give us the 720 divided by 2, that is 360. 360, 720. We continue down. After this, partner salary, legal fee, rent, repair, interest on loan, general expense, insurance, preliminary, director's fee, audit fee, debenture interest, traveling. There is none that goes to the partners among the one we are looking for. Additional information number 1, there is nothing. Number 2 is about VAT in the sales and purchases. Number 3, there's nothing of what we are looking for. Number 4, there's nothing of what we are looking for. 5, the same. 6, the same. But number 7, interest on loan include interest on partner's capital of 100, which is shared according to the profit sharing ratio. There we have it. Interest on capital. Where we are told we share according to the profit sharing ratio. The profit sharing ratio was in the first paragraph up there. James and Katana established partnership business sharing profit and losses in the ratio of 3:2. So the first one will get 3/5, 2/5 for the second one, over 100. So 3/5 times 100. That gives us 60. And this means this one got 40, total 100,000. That was it. And there's nothing else after that. So what remains is for us to share the profit share. That's the last one under here. Profit share, which is now this one, we take according to the profit sharing ratio, 3/5, 2/5 of the 32,000 minus what you have distributed, interest and salary, minus 100,000 minus 720,000. So we'll have 32,000, and then minus 100,000, and then minus 720. That gives us 12,000. And then the first one get 3/5. Give us 847,200. The other one get 2/5 times the 12,000, 564,800. And now we can get total taxable operating incomes. So we add the operating from the top, the 360, and also 60, and also 847,200. This got 1267,200. The other one is 360 and 40 and 564,800. 964,800. Then we add the other one, 720,000 plus 100 plus 14,000. That is 2232, and is starting with what we are distributing here. So after that, we said we normally add the taxable investment income. So here we only had one investment income, that is the dividend from the cooperative society. we had the dividend from the cooperative society, and which we said that is an unqualifying dividend. Withholding tax is not final, should be taxed further. So we come here and say dividend from the Kali Cooperative Society or Kali Cooperative Society. So we take, remember that dividend is for the whole year, and that's why we took the 3/12 for the company. So the other remaining 9/12 is the one that belongs to the partnership, and now we share according to the profit sharing ratio. So the first one get 2/5, the other one 3/5 of the first one is the one that is supposed to get 3/5, this other one 2, of 9/12 of 51,000. So we'll have first 9/12 of 51. So that gives us 38,250. 38,250. Then we share 3/12. That is 3/5 times 38,250. That gives us 22,950 for this one. The other one, 2/5 times that, 15,300. And since there is no other investment income, we now can get the total taxable incomes. So that means that we take the operating plus investment, so 12,67,200, and then we add 22,950. That gives us 12,91,50. The other one is 964,800. And then we add 15,300. That gives us 980,100. And then we can also get the total 22,32,000. And then we add 38,250. That gives us 22,70,250. There. However, we have not really answered the question, because the question required number 2 was that we comment on the tax position of James Katana and the company. So we have to get the tax payable. That's the point. So now we go beyond just the distribution. So we have to determine, we said, we normally tax these partners individually. Now, for example, we'll say tax payable by James. Now, we said we normally tax partners using the graduated scale rates, and this graduated scale rates is usually provided in the tax table to compute the tax payable by James, an individual. We are supposed to use the tax table provided in the question paper to compute the tax payable. This is usually provided in an exam, the first page of your question paper. So I'll use the tax table of the year 2021. For the year 2021, there's a table that normally show, assume that the following rates of tax applied throughout the year of 2021, and we have the monthly taxable pay, annual taxable pay, and the rates of tax in each shilling. So because we are looking for the tax for the whole year, not 1 month, we are going to use the annual taxable pay. In the annual taxable pay, it says between 1 shilling to 288,000, you tax at the rate of 10%. And then between 288,001 to 388,000, the rate is 25%. And then excess over 388,000, you tax at the rate of 30%. Now, for the James, we can see the income is above 388,000. So we'll go up to the rate of 30%. So we start taxing. At the rate of 10%, you normally take the last figure appearing at the rate of 10%. You see, it is 1 shilling to 288. So the last figure is 288. So we take 288,000 times 10%. That gives us 28,800. Then we add you can see between 288,001 to 388,000, 25%. So for this one, you normally get the difference between the last figure in the rate of 25%, which is 388,000, and you minus the last figure in the previous rate of 10%, 288. The difference is 100,000. So you add 100,000 times 25%. That gives you 25,000. And then you add, you see, excess over 388,000, 30%. What does it mean by excess of 388,000? It means we have already taxed the 388. The 288,000 plus 100, that is 388. So whatever is above 388, you take 30%. So we are going to say the above is which one? It is going to be the taxable amount, 1290, 150 minus 388,000, and then you multiply by 30%. So, and then we need to compute that, which is going to be the 1290, 150, and then we minus 388,000. That gives you 902, 150. So we tax at the rate of 30. That gives you 270. So this is going to be 270, 645. 645. Now this one, if you look at that tax table down there, there is a personal relief of 2,400 per month, and which is equivalent to 28,800 per annum. If you're taxing for the whole year, you take per annum, regardless of how many months the person earned the income. Like this one was 9, but we take the whole year. So the personal relief reduces the tax a person is supposed to pay. So 28,800 personal relief. So now we need to add the tax and we minus the personal relief. So it's going to be 28,800 plus 25,000, and then plus 12, that is 7. This is 7. 270, 645. That is going to be 324, 445. And then we minus the personal relief, 28,800. That gives us 295, 645. That is the tax payable by James. And then we have the tax payable by Katana. Now for the Katana income, we find that it is 980, 100. If you go to the tax table, we find that we are going to go all the way to the rate of 30% because it is in excess of 388,000. So we start off just like this one. So the first 288,000, we take 10%. We add the next 100,000 times 25%. And then the excess, which is going to be 980, 100 minus what you have taxed already, the 388. The 288 plus 100, the 388. Where we are told excess over 388, we take 30%. Then we minus the personal relief, 28,800 as provided. So 28,800. So we do the computation. 288,000 times 10%, that is 28,800. This is going to be 25,000. And now this one, 980,100. And then we minus 388. Give us 592,100. And then we multiply by 30%. Give us 177,630. Now we add those taxes. So that one plus 177,630 plus 28,800 plus the 25,000. That gives us 231,430 minus the personal relief, 28,800. That gives us 202,630. That is now the tax payable by Katana. But the question was not about James and Katana only in the required in the required number 2, it was the tax position of James, Katana, and the company. Now, for the company, we said we normally tax at the rate of 30%. So we are going to take 30% of the taxable income, which is 12,750. However, we said if you have if the investment income is subject to withholding tax at the source, you must minus the withholding tax. So withholding tax for this dividend, which is non-qualifying, is 15%. So we take 15% of the 12,750. So we'll take 30% times 12,750. That is 38.25. This 38.25. And then 15% of 12,750. Which is going to be 63.75. Let me do it again. 15% times 12,750. That is 1912.5. So this is going to be 38.25, and then we minus 1912.5, give you 1912.5, and that becomes the tax payable by the company. Now that answers Roman 2, that is required number B, about commenting on the tax position of James, Katana, and the company. There is C now, that citing examples, advise James and Katana on 2 areas of tax avoidance that could explore for the business. Now, although this is a topic to be done later, there is a topic called tax planning. This is where you are supposed to look at all these, but to fully answer the question, I'll just mention them. And then when you do the tax planning, you learn more about it. Now, tax avoidance, those are measures that they can put in place to legally reduce the tax they are supposed to pay. Now, what are those measures? Now, one of them, we saw in additional information number 6 that there was a flotation cost. Flotation cost is usually the cost of issuing shares. So they issued the shares to the public. So instead of issuing shares, the best option they could have taken, usually the company, is to take a loan or issue more debentures. So, one, we have issue debentures or take a loan instead of issuing shares, because costs of loan and debentures, the cost of loans and debentures is called interest, is allowable expense. While cost of shares, that is dividends, are non-allowable expenses. You learn more about this in tax planning. 2, we saw in additional information number 4, there is signing of a 100-year lease agreement. And we said the cost of signing a 100-year lease agreement, when you are looking at the legal costs, 128,400, we treated that as non-allowable. because we say that lease up to 99 years is the one that is allowable. Above 99, we don't allow. So the best option they could have taken is to sign a lease of 99 years instead of 100 years, so that the legal costs of signing become the legal cost of signing become allowable expense. So that is what we had said. And now the last one. We had seen that they had joined a cooperative society whose withholding, the dividend they get, the withholding tax is not final. Instead, they should join a SACCO, where we say that SACCO dividend is our qualifying dividend, withholding tax is final. So, join a SACCO, that is Saving and Credit Cooperative Society, or SACCOs, instead of cooperative society, that was the Carry Cooperative Society, where withholding tax on dividend is final tax. Yeah. So those are the opportunities available for tax avoidance. So that one brings us to the end of this lesson about the conversion of a partnership into a limited company during the year, where we have looked at how you can use the net profit method and the gross profit method to get the taxable income, and how to go ahead and tax the businesses, the partnership, the partners, and also that of the limited company. So that marks actually the end of the taxation of the partnership. Now, when we meet in the next lesson, we'll be looking at the taxation of the next business after partnership, the limited company. For today, we are going to reach there. Until next lesson, thank you very much. See you in the next lesson.
Hello everyone, and welcome back to the lesson. Today I'm going to introduce the seventh topic, that is stakeholder conversations. This topic is divided into 7 subtopics, which are: number 1, developing dialogue over debate; number 2, building trust through adult conversations; 3, the systems inside the board; 4, the systems outside the board; 5, emotional intelligence as a core board competence; 6, managing conflict; 7, stakeholder communication. We're going to begin with the first topic, developing dialogue over debate. But before we get into the first subtopic, I want us to define stakeholders. A stakeholder. Stakeholders refers to those groups without whose support the organization would cease to exist. A stakeholder is any group or individual with an interest or a stake in the operations of a company or organization. So anyone who can affect, or anyone who can be affected by the activities of a company, such a person is known as a stakeholder. And stakeholders have a stake in the company and have the possibility of gaining benefits or experiencing losses or harm as a result of the company's operations. And some types of stakeholder groups include employees, local communities, the local elected officials, and the county government, the central government, regulatory agencies, customers, suppliers, financiers, share owners, non-governmental organizations, and so on. So the stakeholders of each organization are different. And in large organizations, different divisions or operational entities may have different stakeholder groups. So the concept of stakeholder management, I need to remind you, emerged in the 1980s as a practice whereby companies recognize the interests of significant non-financial stakeholders. That is to mean those with sufficient influence and the visibility to gain the company's attention, and took steps to communicate with such groups and address their concerns, usually related to specific issues of the company. Stakeholders. So let's look at the different stakes that these stakeholders have in the company. These groups we are talking about, the expectations of different groups of stakeholders are not the same. I've said that, and that they are often inconsistent with each other. And one of the objectives of corporate governance should be to provide enough satisfaction for each stakeholder group. And the key stakeholder groups include, number one, key stakeholder groups include the customers. Customers. I've said a stakeholder is a group without whose support the organization would cease to exist. Number one, customers. So what is their stake? What interest do customers have in a company? The stake is products, high quality products. All right? Products, services. This is the stake that customers have in a company. Products or services that are of high quality and value. Value and quality. Stakeholders, this is a very important stakeholder group to any company that whose desire or purpose is to make profit or increase shareholder value. Customers are actually stakeholders of a business, and the business exists to serve their customers. All right? The purpose for running a business is so that the business can serve customers. Businesses exist to serve their customers, and customers are actually stakeholders of a business in that they are impacted by the quality of the services, the quality of the products, and their value. Employees. What is the stake of employees in a company? What is the interest? Now, the key stake here for employees is employment income. Employment income. Employees are also interested in safety. Employee safety. Employees would want to work in a place that is secure. So employment income and safety. All right? Employees have a direct stake in a company that they earn income to support themselves, along with other benefits, which could be monetary or non-monetary. So depending on the nature of the business, employees may have also health and safety interest. Employees working on construction sites, on roads, one of their key interests is their safety. Employees working in transport sector, drivers, all right, their safety is very important to them. Employees, the company cannot exist without employees. The company exists to serve customers, a key stakeholder. These customers require products and services. These products and services are offered by employees. If it is a manufacturing company, then the company requires employees to help in the conversion of raw materials into products and services. Without employees, a company cannot meet its objectives. This is the 1, 2, then 3. Investors. What is investors' stake in a company? Their stake is financial returns. If you are to buy shares of a company, then you expect dividends, which is a financial return. Okay? Investors. This could be the shareholders, the debt holders, and so on. Shareholders invest capital in the business and expect to earn a certain rate of return on that invested capital. And they are commonly concerned with the concept of shareholder value. And lumped in with this group of shareholders are also other providers of capital, such as lenders, potential acquirers, and so on. So all shareholders are inherently stakeholders, but stakeholders are not inherently shareholders. So investors have a stake in a company, and their stake is financial returns. A company requires financial resources to produce goods and services. It requires financial resources to pay employees. It requires financial resources to buy assets. So the resources are provided by the investors. 4, suppliers. Suppliers or lenders or vendors. Their stake is revenues. Suppliers' stake, revenues. They are interested in the revenues of the company. They are interested in the safety, revenues and safety. That is their stake in the company, revenues and safety. Suppliers or vendors sell goods or services to the business, and they rely on it for revenue generation and ongoing income. And in many industries, suppliers also have their health and safety on the line. Okay? Their health and safety is also on the line, as they may be directly involved in the company operations. These they deal with the company on regular basis, though they could be interested in their safety also, just like the employees, suppliers. 5, the community. Communities or the society at large. Society. What is the stake? What is the stake of the society in the business? Their stake is health, their stake is safety, all right? Health, they have a stake, safety, economic development is also their stake. Health, safety, economic development. Communities are major stakeholders in large businesses located near them. Why? Because they are impacted by a wide range of things, including job creation, economic development, their health, their safety, and so on. So when a big company enters or exists in a small community, there is an immediate and significant impact on employment, on income, and spending in that area. So with some industries, there is a potential health impact because many companies may alter the environment. The community can be adversely affected by pollution, air pollution, emission of liquids that are dangerous, and so on, through manufacturing or industries. The government is another stakeholder. What is the government's stake in the operations of a company? Taxes, GDP, gross domestic product, taxes, and so on. The government can also be considered a major stakeholder in a business. Why? Because the government collects taxes from the corporate income of a company, as well as from all the people that the company employs. What is sometimes referred to as the payroll taxes, right? It may also be from other spending of the company. The government taxes expenditure of the company, like the value-added tax, and so on. So governments benefit from the overall gross domestic product that companies contribute. So that is the stake that the government may have in a company. So these are the key stakeholder groups that you need to know. So that allows us to get into developing dialogue over debate with stakeholders. That's what we want to consider. Now, candidates, we have outlined some of the interests that different stakeholders have or may have in a company. Earlier on, I had mentioned that it is not possible to satisfy every interest of every stakeholder. So it is important that stakeholders are confident that companies are dealing with their interests with the necessary care. And stakeholder trust in a company can be achieved in particular by involving them in the dilemma that the company is faced with. And that can be done by informing stakeholders, for example, by means of an annual report, and also by communicating with each other. And in the dialogue with stakeholders, both primary and secondary opinions are exchanged. Future interests and expectations are also discussed. And standards are developed with respect to business practice. And ultimately, proper dialogue not only enhances a company's sensitivity to its environment, but also increases the environment's understanding of the dilemmas facing the organization. And stakeholder dialogue is a powerful catalyst for change because it promotes greater transparency, information sharing, and inspires society to work together. So, reporting gives structure to stakeholder dialogue, and reports allow checks to be carried out into whether all the relevant aspects are involved in the dialogue. So reporting also allows each stakeholder involved in the dialogue to be informed about the discussions that take place with the stakeholders. And by means of reports, the stakeholders who are not present are informed about how the company puts its responsibility into practice. And insofar as relevant, how the company is dealing with their rights and interests. And in many cases, companies already holding discussions with stakeholders, such as employee representatives, government institutions, consumer organizations, and those living in the surrounding area. So by including institutions, by including consumer organizations, and those in the surrounding area, also promotes trust. It promotes trust. So, the stakeholder dialogue candidates is a structured, interactive, and proactive process that is aimed at creating sustainable strategies. So entering into a stakeholder dialogue is not an exercise without value. Why? Because with their choice of stakeholder dialogue, companies express respect for stakeholders so as to listen to their contribution and demonstrate their commitment to learn from each other. People like or value when they are incorporated, when they are allowed to participate, when their input is respected, when their opinions are heard, when they are given the microphone to voice their views. So entering into stakeholder dialogue is a valuable process. It is an important exercise. Stakeholder dialogue. And candidates, though stakeholder dialogue is important, we also need to note that it is not a universal remedy, because talking does not solve everything. In some instances, other avenues will be more obvious, such as government regulation, public opinion, and the company's or board's own initiative. By that I mean, stakeholder dialogue is no substitute for companies' own responsibilities. the company remains responsible for its own policy and conduct. And the company is, after all, not a representative democracy. Stakeholders must accept that this involves making choices and reaching compromises. And stakeholder dialogue, therefore, does not imply that stakeholders have the right to be involved in all decisions. They do not, as much as the company or the board may want to involve stakeholders in its operations, stakeholders need to understand that they must, it's not a must that they be involved in all the decisions that the company makes. That all stakeholders' expectations have to be met, it's not a must, or that the company can say hide behind the stakeholder dialogue. The company can also not do that. And therefore, the success of stakeholder dialogue depends on a range of factors. In this lesson, I'm going to discuss the criteria for stakeholder dialogue. Criteria for stakeholder dialogue. Criteria for stakeholder dialogue. The first one is to know and to be understood. Understanding. To know and to be understood. The parties in a dialogue must know each other and know their common areas of interest. After all, without a discussion partner, there can be no dialogue. So that requires that organizations specifically anticipate who will have to bear which consequences of the company's actions in both the short run and in the long run. In both short run and what? And long run. And who will act as a representative of a specific social interest. Of specific social interest. Number 2, trust and reliability. Trust and reliability. A stakeholder dialogue is doomed to failure unless there is a certain level of trust in the integrity of the other party and the value of the dialogue. And of course, a constructive dialogue increases the level of trust, and at the same time, however, in the absence of any form of trust whatsoever, the dialogue will never get off the ground, and consequently, the level of trust also cannot increase. And that means that parties can only allow themselves an open and vulnerable attitude if the other party is also prepared to do it as well. We normally say, you scratch my back, I scratch my back. You scratch my back, I scratch my back. There has to be some level of trust and reliability for stakeholder dialogue to be successful. Number 3, clear rules for dialogue. Clear rules for dialogue. Now, learners, despite the fact that there could be high level of trust between the discussing partners, For example, when the board discusses with management or the board has a discussion with the shareholders, there could be high level of trust between the two. However, it is advisable to agree to procedure with respect, for example, how to deal with the confidential information and the way in which the parties involved report the meeting to their own constituents, how the parties can also report to the media and so on. It is because it is fatal for a confidential discussion if some days later confidential information becomes public, or if the other party is publicly discredited. So the chance of agreements being violated in particular increases as the balance of power between the parties becomes more unequal. So when entering into a dialogue, both parties effectively place restrictions upon themselves. It's important that there are clear rules for dialogue. The fourth point is in relation to the vision. There ought to be a coherent vision on dialogue. Coherent vision. A discussion with stakeholders normally takes place within the framework of a series of discussions. So it is important that the stakeholder is aware of that there will be a series of engagements. For example, for the company, that would imply that there should be a vision on the stakeholder discussions as a whole. It has to be clear, for instance, what is the underlying philosophy? What is the ultimate aim? Which criteria are applied in the selection of stakeholders for dialogue? What will be the frequency of the meetings or the sessions? So the company should guard against being too indiscriminate in that respect, and then create a balance between accepting invitations from stakeholders to attend meeting and alternatively personally invite stakeholders for meetings. So there has to be a coherent vision on dialogue. Then number 5, dialogue skills. Dialogue skills. The parties must possess skills for taking part in a dialogue. The characteristics of a dialogue demand a totally different repertoire and communication style than taking part in a debate. So we are discussing dialogue over debate. There are special skills that are required, communication style that is required, that the participants in a dialogue must possess for the dialogue to be effective. 6, expertise in the subject matter. Expertise in the subject matter. A good dialogue demands good preparation, and therefore conducting a proper dialogue requires the availability of expert knowledge of the subject matter to understand what both you personally and other party are talking about. So if it's a dialogue in relation to financial matters, they need to bring in experts in finance, those who've trained, those who had experience in finance. Otherwise, the dialogue will not be of any value. So if you are discussing corporate governance, if you are discussing legal matters, then there ought to be people who have knowledge of the relevant law. Clear dialogue structure. Clear dialogue structure. Now, to promote a good dialogue, it is desirable that the parties have clear and explicit expectations about the possibilities and limitations of the dialogue. And likewise, it is also required that there ought to be a clear agenda for the meetings and careful recording of the meeting and the follow-up agreements. If that is not in place, then any effort to conduct dialogue meetings will be futile. 8, valid information as basis. Valid information as basis. Now, the dialogue is usually based on information the parties present about the actual situation, and that results in a natural inclination to manipulate the facts or to present only those facts that fit with one's own agenda. So it is therefore important that the facts presented are beyond any doubt, which is why external party will sometimes scrutinize information in advance to assess its validity. It is also increasingly the practice that accountants verify, for example, sustainability reports and so on. So before engaging into a structured dialogue, it is important that the information that will be the subject matter is valid information. Why? Because dialogue is usually based on information the parties present about an actual situation, and is natural for people to manipulate facts so that the facts can fit their own agenda. So if there is to be a constructive dialogue, it's important that that information is checked for its validity. Assess information for validity. 9, successive meetings. Successive meetings. What do I mean by successive meetings? By successive meetings, I mean consecutive meetings. Subsequent meetings. Now, a dialogue cannot be a one-off event. It cannot be an on-off event or a one-off event. Why? Because at the very least, there will have to be feedback on what has been agreed upon. And indeed, a greater number of meetings creates the opportunity for the parties to get to know each other better. And therefore, stakeholder dialogue may require successive meetings in order to exhaust matters or to get feedback. 10, feedback. Feedback of results. It is desirable that discussion partners do not act in isolation from those they are representing. Because when, for example, employees send their representatives to dialogue with the management, or a group of creditors or vendors are brought into the company to discuss or to dialogue with the company, they are mere representatives. They do not act for themselves. They do not speak for themselves. So whatever that is discussed when carrying out a dialogue, then they need to give feedback. It is desirable that the discussion partners do not act in isolation from those they are representing. You may not have all employees on the dialogue table. No. You will have their representatives. So that creates the situation of one of the parties being called back, or sometimes even being overruled, as a result of which agreements made during the dialogue cannot be implemented. So there is nothing as fatal as the management or directors having to say, after 3 constructive meetings, that they cannot, with hindsight, support the conclusions that were reached on the dialogue table. Or if, with the departure of one of the people involved, the successor sees nothing in the results of the earlier meetings. And therefore, mutual trust implies that the parties can rely on the fact that the other party properly represents the interests and views of its constituents. So if there are employee representatives on the table, the management can rely on the fact that the employee representatives properly represents the interests and views of the employees. So feedback of results is the last criteria. We've outlined the criteria for stakeholder dialogue. These are, in other words, factors that would determine the success of stakeholder dialogue: understanding, trust and reliability, clear rules for dialogue, coherent vision on dialogue. Dialogue skills are also necessary. Expertise in the subject matter, clear dialogue structure, valid information as basis of the dialogue, successive meetings, consecutive meetings or subsequent meetings, then feedback of results. So that will bring this lesson to an end. Here is your assignment. Outline 10 factors that may determine the success of stakeholder dialogue. I repeat, outline 10 factors that may determine the success of stakeholder dialogue. Thank you. I hope to meet you in our next session where we continue to discuss stakeholder dialogue. Bye. Hello and welcome to the lesson. The subject is Introduction to Law and Governance. We continue with the topic Introduction to Corporate Governance. In our previous sessions, we defined corporate governance as the way in which corporations are controlled and managed and also directed. In our today's lesson, we will study the role of stakeholders in corporate governance, the role of stakeholders in corporate governance. Candidates, we know that organizations cannot achieve their intended objectives without involvement of various stakeholders. For a company to achieve its objectives, then it requires the input of various stakeholders like the shareholders, the management, the employees, the suppliers, the customers, the government, and so on. In our today's session, we are going to study roles of stakeholders specifically the shareholders, the directors, and the government. We will restrict our study to 3 stakeholders. Number 1, the shareholders. Number 2, the board of directors and the government. Let's begin with the shareholders. What is the role of shareholders in corporate governance? What is the role of shareholders in corporate governance? Now, candidates, shareholders of a company, both jointly and severally, are expected to protect, preserve, and actively exercise the supreme authority of the company in general meetings. The voice of the shareholders, as far as corporate matters are concerned, is to be expressed in the general meetings. They have a duty jointly and severally to exercise supreme authority. Of course, shareholders are the owners of the company. Shareholders appoint the directors to run the affairs of the company on their behalf. So they have certain duties to perform in relation to corporate governance, which is said corporate governance is a way in which corporations are managed and directed. So what is the role of the shareholders in directing and managing a corporation? Number 1, shareholders have a role to ensure that the directors who are appointed are persons that are competent and reliable, persons who can add value to the company when elected or appointed. So directors or the board of directors is a group of individuals who are appointed by the shareholders. So that is the first important role of the shareholders, to appoint the board of directors. And when appointing board of directors, the board should comprise of individuals who are competent and reliable. So when appointing the directors, the shareholders ought to ensure that the individuals who they are putting in office are people who will discharge their functions as required. They ensure that only competent and reliable persons are appointed. So their role is to ensure only competent and reliable persons or individuals are appointed to the board. To ensure only competent and reliable persons are appointed to the board. That is supreme authority of the shareholders, to ensure only competent. Competent means persons who have the required skills, persons who have